And so we understand from at least an economic standpoint, or we should, what this means for us is that either we're going to see significant increases in taxation in this country. And I'm already anticipating that. I work with literally thousands of investors and retirees over the course of a year. And I can't tell you the last time that I met a person that didn't agree that taxes are going to be going up. So we know that that's going to happen.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to Watching the Financial Survival Network. I'm your host, Kerry Lutz. Today, we get the long-awaited GDP numbers, 2% annualized increase. Not so bad. Maybe it isn't as good as it seems. Maybe inflation's higher than is acknowledged, and maybe real economic growth is actually negative. Well, our good friend Matthew Johnson is here to opine on the subject, and you find Matthew at Johnson with an H, WIM.com. And if you got a question for myself or Matthew, shoot us an email, KL@KerryLutz.com. Matthew, great to have you back. So we should all be popping the champagne because annualized growth 2%. That's wonderful, right? We should be celebrating, shouldn't we?
Just not just yet. It's great to be on again. Thanks so much, Kerry.
Sure.
Yeah, it's optimistic. It's optimistic news from the outside looking in. It sounds like, gosh, it certainly beat the expectation of 1.3%. I mean, how could you go wrong with the 2% GDP? But as you said, I think that there's maybe a little bit of window dressing to that, because when you really start to look at the numbers, you start to realize that there's a lot of factors here that could be showing us kind of a false positive. So we have to be somewhat, I think, careful of the numbers and what we're being told and what we think is actually happening. It's one of these things where we always have to address what we're hearing with what the facts really are. And we have to, unfortunately, do a lot of our own fact checking as individuals in today's society.
I just think of the GDP number. It really isn't accurate because it doesn't measure wealth. It incorporates debt into that number. So the more debt you have, the faster the GDP goes up. At one time, Bernie Madoff was a net positive to the GDP, and we see how that wound up. So the fact is that there's a lot more to the number than meets the eye. I mean, look, when gasoline prices were up, that lifted retail sales. Peachy number. So like you say, you really got to look underneath the hood to really help you figure out what exactly is going on. And mentioned earlier, debt to GDP ratio. What's the significance there?
Well, I think it's very significant. In fact, I'm very concerned with it, as most Americans should be, because if we look at the debt to GDP ratio right now, Kerry, we're in a position where we are just under the debt to GDP ratios of World War II. That should be absolutely scary to us. And what does that mean to us? Well, number one, if we look at what spending has done, back in 2022, the debt of this country rose by 35%. 35%. And they're expecting that there could be potentially another 30 to 35% increase on top of that just in 2023 alone. Recently, I was reading an article from the Peterson Foundation, and they were suggesting that in the next 10 years, if we continue to stay on this trajectory that we're on right now as a nation, we're going to be in a position where just to service the U.S. debt alone, just that debt service is going to be larger than all of Medicare and all of national defense. I mean, think about it. Right now, in 2000, 2023, we have service to this debt of over $475 billion. That's with a B. That is a big number. And so we understand from at least an economic standpoint, or we should, what this means for us is that either we're going to see significant increases in taxation in this country. And I'm already anticipating that. I work with literally thousands of investors and retirees over the course of a year. And I can't tell you the last time that I met a person that didn't agree that taxes are going to be going up. So we know that that's going to happen. But we can't just see taxes go up in order to fix this problem. We're also going to see, or have to see, our government spend less. And unfortunately, Kerry, I'm not optimistic. I don't know about you, but I'm not optimistic that there's anyone in Washington that wants to reduce spending.
Well, maybe Rand Paul.
Okay,
but they're a distinct minority. But you know what they say? Thomas Jefferson said it, one man with courage is a majority, right?
Could be. Let's hope, huh? Let's hope.
Well, yeah, the situation bleak, but I think like we've got the best looking house in Baltimore. The rest of the world is so bad that the U.S. looks good.
Well, and to say it a different way, we are the cleanest shirt in the hamper. I get that. But we also want to be very cognizant of today. We are on the edge of the largest majority of human beings in the United States today that are going to be retiring. I don't know that it's absolutely precise, but they say as of February of 2024, Kerry, we're going to have the peak of retirement from the baby boomer generation. And we need to be thinking about that because let's just put ourselves in their shoes. These are people that have spent the last 30 plus years of their life, and they've been on the accumulation stage, right? They've been saving, they've been working to save, they've been contributing and compounding their money. And now they come to retirement, and they come to retirement at an economic stage, which is very uncertain, right? We still have inflation. We have the Federal Reserve that seems to be absolutely exacerbating the defaults within banks. The FDIC just came out with a report that said where they had only 4 problem banks on their watch list. Now they have over 43 banks on their watch list. They're coming to retirement during a stage of life in which the majority of them do not have interest. They do not have dividends. They are still stuck in this growth-based investment mode because that's what they've always been in. And you're asking a person for the last 30 years has done nothing but save to now start taking withdrawals. That's a very scary time for them. This is something that's a big transition for so many people. And the reason that we have to be so sensitive to what's going on around us and how our money is invested, where we're putting our money and what our money is doing for us is if we're the average retiree, we're still focused on, say, sitting in growth-based stocks that aren't paying us dividends. And all of a sudden, the rope is being squeezed around the economic neck as the feds are doing what they're going to do and the government's continuing to spend more. And then that's justifying a higher tax implication down the road. Think about what that's going to do to potentially just absolutely devastate the portfolios of this country. That's a big concern for myself. That's a big concern for many Americans today.
Well, I have the solution. We got to get the old people to spend more, charge more on their credit cards. So it's not what the country needs is a more flamboyant elderly class like myself. And then we'll solve all the problems. We'll keep the economy going. Buy houses, buy cars, just go out there and spend. Don't worry about leaving anything to your kids. Just leave them the loan statements, right?
There you go.
Solution.
Yeah. I found that older generations, and especially the generation, our grandparents, they went through the Great Depression, right? If you had a team of mules, you could not get them to take and put their money back into the stock market because they learned how important that principle was to them, right? Well, the next generation that came behind, they were definitely more the spenders. But I think we're going to see between required minimum distributions, where we have these mandatory withdrawals out of the stock market, we see that there is most definitely a bubble that is being created within AI. And I'm not saying that that's bad, but we want to think back in time, right? We want to think back to the tech bubble burst where they said, this is going to go to the moon. And it didn't. Eventually, these things are going to wind down. And we have to be very exacting with what our long-term plan is. Is it really growth, or is it more or less income? Because if you do have income, like you said, now you can spend, right? You can spend more freely with more freedom.
So true. I couldn't agree with you more. One of the things in the notes I have here, you say, be patient, focus on dividends, collect them or spend them, but be ready to buy as there's likely to be more Kmart blue light specials coming. I think that's a bad analogy because Kmart's like all but gone, right? Haven't they disappeared?
Okay. All right. Well, let's turn back the clock to that Kmart blue light special. When you walked into a Kmart, Kerry, come on. When you saw that blue light flashing on the end of the aisle, you knew where to go, right?
You were trained, man.
That's right. That's right.
Pavlovian response.
That's right.
You see a blue light and you immediately get your credit card out.
That's right. Well, the reason I say what I say is because obviously, in June, the Federal Reserve gets together, and there was a very split consensus as to whether we were going to actually get another rate hike or if we were going to get a pause. Now, what we saw transpire was actually that we didn't get a pause. What we got was, just joking, we're going to do a skip. And so, just a minute ago, you talked about we need to be bigger spenders. Well, interestingly enough, when you actually dissect the core PCE and you're looking at where spending is actually taking place, we're starting to see that there's slowdown in certain parts of the sector, but there's also continued strength within home building and that sort of thing.
Yeah. What's with that? Explain that one to me, Matthew.
Well, we still very much have a shortage. When we think about single family homes, when we think about the number of individuals that we have in this country versus actual legitimate housing, we still very much have a shortage. And when you think about what's happening, people have to be able to live someplace, and people are getting more value from the resale of their home. But we have a lot of retirees that are still maintaining their big home that they had when they were raising their kids. And now what are they wanting to do? They're wanting to get into, ranch style homes or trying to downsize a little bit. And so as a result, many of them have the capital, and many of them are saying, you know what, this is not high inflation. If you want high inflation, let's take you back to the 1980s and 1990s. That was high inflation. So they're still looking at today's interest rate saying, this isn't bad. This is doable. We've got the capital to do this. We want to build. And they're building to spec so that they can enjoy their retirement in something that they want to spend the rest of their years living in.
All right. So I am looking at the PHLX Housing Index. And I follow housing a lot because it used to be an analog for interest rates. All right. But so right now it's at a near all-time high. If I have it right. If you look at Lennar, Pulte Homes, KB Homes, and look at DH, whatever it was, but all of them are trading at 5-year highs. Those stocks, probably all-time highs. The only one that isn't is Toll Brothers, which focuses more on the luxury end. So what does this tell us here, Matthew?
Well, again, we have to look at what the trends are doing. And I'm seeing an awful lot of my clients that are building in, they're really building into what they want to be able to have. I just had a client that decided that he was going to leave the great state of Minnesota, and he was going to be going down to Hilton Head. And he said, we looked around, we just didn't find anything that really, tickled our fancy. It was nothing that really fit the bill for us. So we just decided, we've got the capital, we have accessibility to credit, we've got a lot of credit and equity built up in our home. We're going to go ahead and we're going to build. Now, when it comes to luxury homes, I think that we have a few more of the luxury homes that are available for people to actually purchase. But many of the homes that are being purchased today or rather built today, I think are the homes that are just below that luxury class. And that's the reason that we're seeing the drive in that demand.
And that's in the face of increasing interest rates. And now you're starting to see builders actually get back into the credit business. Remember, after the big bust in 08 and 09, before that, the home builders are making more money on their kickbacks from financing to banks, et cetera. Some of them were even packaging their own mortgage-backed securities. And that all fell by the wayside. There were like no incentives, but now they're looking to soften the blow. I think there's also been some home builders like in that middle tier, mid to upper middle tier, they cut back on features as well, maybe made the houses a little bit smaller to keep the affordability there. I just wonder how long the show goes on. I go back to the 80s with double-digit interest rates. The first mortgage I ever got was on a co-op. Paid a whopping $117,000 for it in Fort Lee, New Jersey. I had an 8.5% interest rate plus the common charges. And this was like a struggle for a young, newly married couple. But now, housing prices are quadruple what they were in the 80s. Rates aren't what they were in the 80s, but hey, they're over 5%. That's a nosebleed territory.
Absolutely. And I think that there's one other factor, though I know that this is not all encompassing, but we see that there's several states now that are trying to become more attractive to retirees, and they're starting to take and make adjustments to their income tax, right? And so what this is doing is this is attracting those retirees because they're saying, hey, if we don't have to pay income tax, now we have more capital, we have more cash flow, and now we can justify. Isn't it interesting, Kerry, how as human beings, we're kind of our own best attorneys, right? We justify in our mind how we're able to make something work. And so I see a lot of my clients that have moved from other states into the state of Iowa. Why? Because we just got done eliminating state income tax from any distribution from any retirement program. That's really, really nice. You look at other states like Florida, you look at states in the Carolinas where they're reducing this. Yeah. These are the things that are going to be attracting people to these states, and they're going to be hopefully seeing a boom in building.
That's pretty brilliant to get rid of all the passive income taxes, state income taxes. So basically, you're 65 and over, and you could live state tax free. You let all the young people pay for the costs of government. You're there. You're not, well, I guess you are spending some money. You got to live, right? You got to drive a car. So that's really kind of enlightened leadership in this day and age, because it's very difficult for a state, never heard of it, to just dump an income tax. They've talked about it, but there's never been a state that's done it. So this is kind of like engineering that tax to attract the people and make it more attractive to those retirees who, hey, look at Florida. The states that have been attracting retirees, their GDP is increasing way, way faster than the states that are shedding retirees.
Absolutely, 100%. I think it's very clever and it's very forward thinking, because when you think about it, who's going to have more money, the 35-year-old or the 65-year-old that's already, amassed the wealth over the course of time, and now they're hitting the distribution stage of their life where they don't have a job to tie them down. Now they can go out and they can consume, they can buy, they can be able to enjoy more luxury items. This is really forward thinking, and I'm very, very pleased to be seeing it, because I think oftentimes there's too many things that get in the way of economic growth when it comes to political agendas and so on and so forth. You see the state of Minnesota, prime example. They've squandered so much of the state income tax. They've squandered so much of the resources that they've brought in from their citizens, and they're starting to drive people out. So if they would just spend some time driving out the mosquitoes, they would probably attract more people. But that's not going to happen, because they got 10,000 lakes there.
Failed states. So These are failing states. Three or four categories of states. There are states that are growing, mostly in the South, Southwest. There are states that are more or less stable, and really that's kind of like Iowa's and the Kansas's. Not really a lot of growth there. And then there's states that are failing, and I would put Minnesota as one of them. And then there are failed states like California, New York, New Jersey. Connecticut probably falls into that. So I find it interesting that a state like Iowa is stable, Farm Belt, all that, really figured this out. They kind of unraveled the riddle. It used to be like states didn't tax their own state workers' pensions, but a lot of them do that now. Well, interesting times here. When we have this conversation in a year, what do you think we're going to be seeing here, Matthew?
Oh boy, that's a $64,000 question, isn't it? I think that there is some potential that we can pull this off, but my biggest concern is that right now we are getting very close to the edge of a potential recession. The Federal Reserve seems absolutely resolved to continue to raise interest rates, to continue to contract the economy. Part of the problem, a big part of the problem, is the government spending, and it's working contrary to what they're trying to do. And so they keep hammering on this. And if the Federal Reserve would just back off and let things continue to calm down, I think that they would work their way down. Now, I still think that a 2% inflation factor is way unreasonable. I think it's still way too unachievable in the short term. But in this case, if they keep pushing these interest rates higher, it's going to be interesting. Are we going to have a full-blown recession? I'm not sure. I've been suggesting to many clients we're not going to see any kind of a rate cut for inflation until at least the end of the first quarter of 2024. But we shall see. We shall see. There's going to be a lot of time between now and then.
All right. Well, I think that sums it up well. In any event, if you've got a question for Matthew or myself, KL@KerryLutz.com. We'll get you an answer quick. And while you're at it, just go over to the show notes, financialsurvivalnetwork.com. You'll find a link to Matthew's site, Johnson with an H, WIM.com. And hey, while you're there, sign up for your free newsletter. Matthew, always a pleasure. Thanks for coming on.
Thanks so much, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.